Welcome to this new episode of Your Next Trade Code Today Fed Cuts Rate. So on Wednesday, G. Powell and the FOMC decided, as expected, to cut rates by 25 bips. And in the meantime, market is making new highs after new highs. And the Trump administration is fairly right to say, everyone is winning. And as you're going to see later today, there are many parts of the market that seems pretty much overbought, bit of reminder that it's almost like 2000. We looked last week about Oracle and how this prophecy is pushing the whole space of AI. But literally what we had over the midweek is Powell saying, I need to do a risk management cut. Why? Because the job market is deteriorating a bit. We're still having, inflation that is around 3%. And as we have been discussing, 3% target is probably now the new 2%. But the job market, as we said, through the NAFPs and some other indicators, is saying, the economy is barely creating any new jobs. So if we look at what happened for the week to date asset performance, this is the same picture as before. We have here the stocks that are up 1.2% for the S&P, 2.2% for the Nasdaq. So pretty much what was expected from the straddle from last week, which was plus 1.2%. So stocks have been positive, making their run going higher and higher. If you look at currencies, actually flattish for the US dollar, but there was a bit of weakening just after the FOMC meeting, and the US dollar recovered from that. Bitcoin a bit weakish, with Ethereum down 5% for the week, and gold, WTI, copper more or less flattish. What about the week-to-date industry performance? As you can see here, this is for the Nasdaq and for the Russell, the S&P. The winners are still the same. We are talking semiconductors, we are talking software, technology, internet, cybersecurity. So pretty much the market has been led by the same names, the same sectors, the same industries. And on the other end of the spectrum, we do have actually home builders pretty weak. So we had Lena earnings after the close on Thursday. The stock was weak yesterday. On Friday. Why? Because they are still saying that the housing market is not that strong. And in the meantime, actually yields have been up for the week. So as we're going to be seeing later, despite the cut and some expectations of further cut in the month of October and December, actually the US 10 years bonds from the 4% level and now around 4.13%. And that means any sectors that has been that has a correlation through yields has been struggling, and obviously home builders is one of them. But as we see here on that page, you see utilities down 0.6%. Anything that is defensive, consumer staples down 1.2%. If you look actually at the consumer staples XLP versus the SPY, that has been in a downtrend for the last 6 months roughly. Why? Because this is one of the sector that is risk-off sector. That means, when the market is going higher and higher, this sector is really underperforming. But as I said, anything that is yields related, utilities, real estate have been struggling. What is interesting as well is not only the defensive sectors have been underperforming, but for this week, materials, industrials have been starting to struggle a bit, telling me that actually the GDP, the US growth is not as strong as what some will want to believe. So what about the yields? Looking at the US 10 years, as you see here, 4.13%. We are up 6 bips for the week. So this is not massive, but that tells you that's probably the same story as last time, which was a year ago, when the Fed cut the rates, and in the meantime, yields were going higher. Why? Because you still in the US running a big deficit. We are talking 6 to 7%. The Trump administration is still trying to run the economy very hard, but that means inflation is probably sticky, around 3%, and this is one of the reasons why you see the US 10 years bouncing. As well, for the next few sessions, what we're going to see in the US market is, because this is the end of the month, there is bond supply. With bond supply, the investors are asking for higher yields. For the Fed funds rates, I want to jump into the CME website. So you can see the CME website and what are the expectations for the next FOMC meeting starting with October. So the odds are for roughly 92% of a cut in October by 25 bips. And then if you go into the next FOMC meeting in December, this is the same. You're going to have another cut of 25 bips. So the sequence just started. Despite the risk management cut that was announced by G. Powell and the FOMC, now the market is expecting twice a cut for the FOMC, for the Fed funds rates. What about the VIX volatility? 15.5%. What is interesting is implied volatility is pretty low, but actually realized volatility, RV, as we're going to see later, is much, much lower. So there is a case actually for implied volatility to go lower. Why? Because the differential between IV and realized volatility, if you do that on an Excel spreadsheet, you'll see is pretty high. We are talking probably a premium that is too high. So let's look now at the technical analysis, what I call the dodgy technical analysis, starting with the S&P futures. The trend is still your friend, but as you can see, if you do one of those dodgy lines, you will see that we are close to the actually to this resistance. I think we are 1% away. For the Nasdaq, we have been making new highs. This is the same picture. Why? Because we are outperforming the overall market with the Nasdaq. Interesting one is the Russell. So at the start of July, we clearly said that there was a case to be long Russell 2000. So we were roughly into the 2100 levels. Since then, we have been on the ramp. And as you can see, you can almost say that this is a double top, and even more, that could be a triple top. So the small and mid cap companies with lots of them, we are talking 50% of the Russell companies, I think, are not making any money. I've been on a tear, and this is the same picture. If you look at something that we're going to be discussing later, this is the Goldman Sachs momentum
translation
index.
Following the alerts that were activated a short time ago in the Lashish area.
Something here, sorry, up. This is the Goldman Sachs index momentum stocks, and as you can see, since over the last 5 sessions, we are talking like a crazy move. We are talking over the last 10 days, 20% of move. So retail, we are talking retail traders are in total control of this market. But that tells you about actually that the market is a bit overbought, and that's an understatement. I want to flag as well the euro dollar because we had a big move on Wednesday just after the FOMC meeting where we went into 119 and above. So a bit of a one-off, and since then we have been coming back. Another one, this is Oracle. Oracle, we discussed the Oracle prophecy last weekend and how it feels pretty much like this Oracle deal with ChatGPT, which is not sure that it's really financed, is probably one of the examples of the top in the market. So this is Oracle coming back a bit from the 340 level, but still, you still get this massive gap. And finally, as we discuss special situation, and this is something that we teach in the 4x4 and as well in our trading community, we discussed obviously the new stocks into the S&P 500. So that was on the close on Friday, where we had AppLovin and Robinhood, who both went into the S&P. And as you can see, since the announcement of the AppLovin going into the S&P, the stock is up 30%. And if you look actually at the stock on an intraday basis, at the close, the stock went from 630 to 650. That was the same with Robinhood. Why? Because passive investors, anything that is indexed, will have to be buying at the close, and that explained this huge volume that we had for the day on Friday. So always important to look at those special situations. Let's go back into what we had for the week. So this is the chart of the S&P 500 for the last 5 days. This is pretty much the same chart over and over, where you start and you go sideways, you go up and you go sideways. So picture is a bit of kind of volatility, let's say 50 to 60 points on the S&P future. So that was for Wednesday. FOMC meeting, but pretty much same story as always, plus 1.2% for the week. So we had a bit of a retail sales, so a bit of macro, and as you can see, the retail sales, if you put aside the January effect, have been very, very strong month after month. So the US consumer is still king, making 70% of the US GDP, but you can as well say that if you put aside inflation, the numbers are not as good as what they think to say. But overall, very strong month of August, plus 0.7% month on month and plus 5.4% year on year. So very strong month. So if you look at the macro, still pretty good. As I said, we had on Friday the option expiry, where we discussed last week that normally Friday was pretty weak for the option expiry. And guess what? Any seasonality so far in September and for the option expiry has been put into the toilet. Why? Because the market has been very strong and so tons of inflows. So for this week, we had 70 billion inflows in the US, mostly coming from US money and mostly because, of the index weighting. We are talking 30 to 40 billion going into tech. And I'll explain, why this is the big picture here. This is mostly indexes built by brokers like, let's say, Goldman Sachs. And as you can see over the last 5 days, we get the high beta Momo index, so an index that is constructed around high beta stocks, plus 12%. We are talking liquid more short, plus 10%. We are talking uranium, plus 10%. So popular retail longs, so you can call them meme stocks, very, very strong. We are talking 10% over 5 days. This is just an insane number. And that tells you how the market is spinning up on the way up, and it's quite scary. As well, what we had the deal between Intel and NVDA, where Intel announced that NVIDIA was buying for $5 billion of stocks. The beauty of this Trump administration that every single day you have a new deal. And the second beauty of it is they will decide where you should be putting your money. So it's up for you to decide if it's a good thing or a bad thing. I have my own judgment. So what about the catalyst going into next week? So we do, as always, have a bit of macro, but less than usual because this is the end of the month. So we get the flash PMIs on Tuesday. So far, most recently, they have been trading pretty well on the manufacturing and on the services. So economies are picking up again. We have the PCE and personal income on Friday with the University of Michigan. And let's have a look as well at the weekly claims on Thursday, because, this is the part of the mandate that the Fed is looking at. In terms of earnings, one that I will be looking at is Micron on Tuesday and Costco on Thursday. Why? Because Micron, this is the whole AI space, and Costco, that gives me a bit of picture of how the retail world is doing in the US. Tons of Fed speakers. Why? Because this is the end of the blackout period with the FOMC meeting last week, where we had tons of Fed speakers. Most important one probably going to be on Tuesday, Powell, but you're going to have the new member, Miran, that was coming with some funny dots from the FOMC. As well, what we have is we have a bit of bond supply for this week. So from 2 years to 7 years, altogether, we are talking almost 200 billion of bond supply coming for this week, which explains as well why yields have been going up a bit. And what I want to flag is, as I said, the S&P SPY 10 days realized volatility. As you can see, we are back to the 5% level. And in the meantime, so you get 5% for the 10 days. So if you look at the 10 days implied volatility, let's go back here. Okay, so this is your 10 days, 9 days, you get 12.4%. So literally there is a case here for actually, even if you think that implied volatility is compressed, that for implied volatility to go lower. I'm not saying to go short implied volatility because from experience, you can be making a bit of money on the way down, not from experience shorting the volatility, but when volatility spikes, there is the odds are for the volatility spikes obviously to be much, much bigger. But that tells you that volatility is for indexes implied and realized is very much compressed. We are in the same market structure where we got inflows, we're passive, where people are going for the same names into AIs, tech, uranium, semiconductors. So that translates into the S&P weekly straddle as plus minus 1.1%. So we are going lower than it was last week. So PCE, as I said, bonds, Fed speakers, flash PMIs, and finally, here this is the chart of some kind of correlation between the S&P 500 on the left-hand side and the T bonds here that will be on the right hand side. So that would be for the future of the 10 years. And as you can see, most recently, there's been a bit of a divergence. As I said, stocks have been up 1.2% for this week. And in the meantime, yields have been going higher, meaning bonds have been sold off. And as you can see, if you believe that those two at some point should be follow each other, there has been a bit of a catch. So we are talking potential 2 to 3% correction for the S&P 500 for the next 2 to 3 weeks. So this is it for me for this week. If you got any questions about what we do through the 4x4 video series, through the mentoring, many people are joining. Actually, I got a good call this week for the mentoring. If you want to join the trading community on Discord, here, this is the link, or you can send me an email. There is one free channel for the trading community on Discord, and then you're going to have beyond the paywall, roughly 30 channels to access. So this is it for me for this week. Have a good trading week. Bye-bye.